Welcome to the latest episode of our Sound of Finance podcast. My name is James Williams. I'm a senior consultant at zeb.consulting, and I'm joined today by Gijs Hilgers, a senior advisor at zeb in our Zurich office. Today we'll be discussing financial planning in an agile context and the shifting role of CFOs in banking. Welcome, Gijs. Thank you so much for taking time to sit down with me today.
Thank you, James. I'm very excited to be here, and I'm looking forward to our discussion.
Well, today we'll be discussing one of the most important trends in the finance area now, at least in my perception, and that is informed both by shifting cultural and organizational landscapes, but is also influenced a lot by the technological changes that have been going on. So I think you're absolutely right, a big topic. Why don't we start off by having you tell our listeners briefly about your background working in finance?
Well, I have almost 20 years of experience in financial services. I spent most of my time at ABN AMRO, where I had different types of roles, commercial roles, strategic roles, and most recently I was the CFO of ABN AMRO's commercial bank. And next to that, I was also a board member at New 10, which is ABN AMRO's digital SME bank. And currently I work as a consultant, as an independent consultant, and I'm also a senior advisor to ZEB. And my clients are mainly the global financial institutions that have to deal with topics that relate to the CFO domain, but also topics related to digital and agile transformations.
Gijs, I'm glad you mentioned global financial institutions, because my impression is that when most people talk about agile organizations, tech companies come to mind, perhaps some other smaller startups, but generally not large banks, which are still thought of as traditionally hierarchical, maybe even static environments. So for those listeners that might not be familiar, can you tell us what it is, what you mean when you talk about agility, and in particular what it means in the context of these financial institutions?
Well, agility has a lot to do with behavior, has a lot to do with culture. In the core, it's actually the ability to be able to adjust to changing circumstances, or in particular to changing client preferences. So what you say about startups or tech companies, which are generally smaller, less complex, tend to focus on a single product or at least a limited set of products that don't have to deal with legacy culture or legacy systems. It's indeed true that those companies are by nature more agile than the traditional financial institutions. And that's actually also when we decided at ABN AMRO to build a digital SME bank, New 10, to organize that standalone, separately from the mother bank. However, at the same time, we also see that more and more, let's say, traditional institutions understand that the world is changing rapidly with all the innovation and digitalization going on. And that's why they start to organize or to actually implement an agile operating model, which means that instead of having the traditional silo organization, they organize cross-functional teams, cross-functional value streams. So those processes that add value to clients, they organize those in cross-functional teams. And those teams are actually self-steering teams. They are really empowered to make their own decisions on a day-to-day basis. And what's crucial in the agile approach is that the teams work in short cycles, typically 2 to 3 week sprints, in order to adapt client feedback in the development process on an ongoing basis, and to be able to reprioritize the work on an ongoing basis. And this is all with the aim to, well, first of all, to deliver faster, but above all, to deliver solutions, products, and services that better align with the client preferences and with the client needs.
Are we seeing this agile transformation across all areas of the bank, or is it limited more towards the technological, maybe the IT sections, or do we really see it in the CFO area as well?
Well, what we see in the market is that most institutions tend to focus their value streams around those activities that are indeed involved in the solutions or the delivery of IT solutions. So from a business perspective, that means that product management, product development, channel management, those functions are organized in the value streams, in the cross-functional value streams with IT solutions, with the IT people that are involved in the development of these IT solutions. So that also means that significant parts of the organization, like, for instance, sales or sales support, or on the IT side, the hardware people, that those are not organized in the value streams. And I'm not saying that they can't be organized in value streams or that they can't benefit from the agile approach, but this is what we typically see.
Now, Gijs, you mentioned some of the benefits earlier, but just concretely, what can a bank gain? What other benefits are there through the adoption of an agile approach?
What we typically see in the market is that organizations tend to focus their value streams around those activities that are involved in the delivery of IT solutions. So from a business perspective, that means that product management, product development, channel management, those activities are organized in cross-functional teams with IT, where the IT solutions people are part of the value stream. And this also means that significant parts of the organization are out of scope of the value streams. So typically, salespeople, sales support, or on the IT side, the hardware people are not organized in the value streams. And I'm not saying that they can't be organized in value streams or they could not benefit from working agile, but this is what we typically see. And the interesting thing is that the reason why organizations do this is that simply those activities benefit the most from this agile approach. And the benefits that we see, and that's the interesting thing, is what we hear from our clients is actually also being supported by a recent ZDB survey, is that, first of all, organizations that have an agile model are able to deliver a higher client satisfaction, which makes sense if you are able to deliver faster and you deliver solutions that better align with the client needs. Yeah, that, of course, has a positive impact on client satisfaction. But the same is also true for employee satisfaction. So the employees in the value streams, they are really empowered to make their own decisions. They simply face less bureaucracy, and this has a positive impact on the ownership of the work and the engagement of the employees. And that's what you see reflected in the employee satisfaction surveys. And last but not least, and I say this as a former CFO, there's also a positive impact on operational efficiency. So if you invest money in IT or in product development, you simply get more value out of it. And that's why I also tell my clients that implementing an agile model has a business case in itself. So whether that is from additional value that's being delivered or from cost saving doesn't really matter, but there is a business case to implementing an agile operating model.
Now, you mentioned earlier that there's a cultural shift that's necessary and that accompanies the adoption of agility. Can you maybe tell us a little bit more about what is required there and what you might say to a financial institution that has either just started down this path towards agility or perhaps would like to begin to?
I think it's first of all simply just good to realize that it's not only about an organizational change, but that there's also a significant cultural element to implementing an agile approach. And we all know that cultural change is not going to happen overnight. So you have to be prepared that this will be at least a multi-year journey. And next to that, I think that the tone at the top is crucial. I think the senior leaders of the organization really have to embrace the concept and the idea of agile working. And they really have to be willing to adjust their own way of working. So for instance, if you start to organize self-steering teams that are empowered to make their own decisions, then of course it's really important that the senior leaders of the organization also trust the people in the value streams to make these decisions. Otherwise, it will hard to become self-steering. And in particular, if you look at the CFO, the CFO is supposed to be in control of the organization. Yeah, it can feel uncomfortable to stop, for instance, controlling project cost and to trust value streams to make their own decisions. But if you don't do that, it will definitely jeopardize the benefits you're going to reap from Agile. And two other elements I'd like to mention, and both actually relate to my experience at ABN AMRO. And the first one's actually when we started to implement an Agile model, we also decided to go for a Big Bang approach, which doesn't mean that we became Agile overnight, but we decided to implement value streams throughout the organization. So not a single business line or a single product or a single geography, but throughout the organization. And I think the good news is that from that moment on, we were all on the same journey. We all had to learn to speak the new same language. And the key takeaway for me is that if you want to drive cultural change, if you want to realize cultural change, it's important to involve the wider organization and not just an isolated set of people or an isolated department. And the second element relates actually to the value streams. And as I mentioned, also at ABN AMRO, the value streams had a business element and an IT element in it. And the IT people in the value stream were still reporting hierarchically into IT, into the group COO. And the business side was still reporting into the business line CEO. The value stream owner, so the person being end responsible for the cross-functional team, also reported into the business. And that really helped breaking the silos. So from that moment on, we had completely different dialogues in the business management team. So before Agile, it was a lot of the time was about, okay, IT doesn't deliver, or IT is too expensive, or IT doesn't understand what we're asking for. And after the Agile implementation, it was more like, okay, we're trying to deliver value to a client. Some things work, some things don't. What can we do about it to make it work? So to me, that was a real game changer. And I think that if you want to enable cross-functional teams to optimize their way of working, it's really crucial that you kill silo mentality. Now I mentioned two elements that work really well in the ABN AMRO organization. And at the same time, I would also like to stress that I don't feel that what works for one organization per se works for the other. I think there's no one size fits all, and you always have to take into account the existing culture and the existing organization. But organizations definitely can learn from other organizations that are, well, let's say, ahead of the curve. So yeah, I think culture is a very big topic, and we can talk very long about this. But maybe as a final note, I would say that if you want to embark on this agile journey, then I think you have to be ambitious and you have to be brave when it comes to decision making. But at the same time, don't be too hard on yourself. You also have to allow for a learning curve.
I think one aspect that we haven't covered yet, but I find really quite interesting, and perhaps it goes along with what you were saying earlier about the overlap between technology and then the business side, is implementing rolling forecasts, particularly in the context of agile planning. Could you tell us perhaps a bit about how agility would change these traditional reporting and planning structures?
Let me start with the reporting element. In line with what I just mentioned, I think that when it comes to those functions and those people that are involved in data management and data delivery, which is of course crucial when it comes to reporting, that those functions can also benefit from working in a cross-functional team with IT. But this is more from an organizational perspective. When it comes to reporting structure, I don't think that reporting structures in itself have to change as a result of Agile. As long as you don't change the group structure or the business line structure, in particular the external reporting, so investor reporting or regulatory reporting, don't change. When it comes to management reporting, then I think there are two elements that could be interesting. First of all, it could be interesting to add a financial view on a value stream level. So next to the group or the business line or the client segment view, you could also have a value stream view that gives you the view on the profitability per value stream, or maybe even the profitability on the underlying products or services. And that also gives a view on to what extent the value stream contributes to the profitability of the firm as a whole, which could be valuable input for future resource allocation discussions. The second element I would like to mention is that next to the financial view per value stream, it could also be interesting to have a view on a number of non-financial KPIs, since this enables you to steer the value streams when it comes to value delivery. Having said that, if it comes to the planning process, I think in an agile organization, it's helpful if the planning process in itself also has a bit of flexibility or agility in it. So instead of having let's say, a static yearly budget process, a multi-year rolling forecast that's being updated on a quarterly basis better aligns with the cadence of the agile organization. And it allows you to incorporate strategic choices or reprioritizations on an ongoing basis. And that doesn't mean that you have to change your strategy each and every quarter, 180 degrees, but at least it allows you to adopt the newest insights. And personally, I also prefer, next to the multi-year rolling forecast, to have a 12-month rolling forecast. Could be a bit of a technical exercise where you just, based on the running actuals, you extrapolate 12 months ahead, you add some significant items you are aware of, and that gives you a view for the next 12 months. I realize that this works best in let's say, a flow business, a more stable business, and in a transactional driven business where single events have significant impact on the financials, it's a bit more difficult. But still, I think the 12 months rolling forecast adds a lot of value compared to the multi-year rolling forecast.
Now, we've hit on a lot of interesting topics here. Much of the change surrounding processes and even organization and culture ultimately depend on the overlap of business and technology here. That sort of brings it together. So maybe you can expand on this idea a bit. And in particular, how can the CFO facilitate an exchange between IT and business in this new agile context?
In order to reap the full benefits of agile, and I think this is in line with what I just mentioned about the tone at the top, but to reap the full benefits, the CFO and also the broader finance organization have to adjust their way of working. I think the good news is that not everything is going to change. The CFO still has a crucial role when it comes to strategy development and setting financial ambitions. And the business is still responsible for translating the strategy in what I like to call a book of work, a set of initiatives that have to be delivered to execute the strategy. And finance can still support that process by making business cases, at least for the larger pillars of the strategy. But what is going to change, however, is that finance has to give up a certain granularity in order to empower the value streams, the cross-functional teams, to make their own decisions. So when the strategy has been designed, then finance is going to set targets and to set budgets based on the strategy and the book of work on a group level, on a business line level, on a value stream level, but no longer on individual project level. As the idea in the agile model is that you stop managing individual projects. So the value stream owners manage their book of work. So if you allocate budget, or I prefer to call it, if you allocate capacity to the value streams, then it's up to the value streams, business and IT together, to deploy that capacity to the best of their ability in order to deliver the highest value to clients. So at ABN AMRO, when we implemented the agile model, at the same time, we also decided to abandon the governance around project portfolio management. And as a former CFO, I can tell you that can feel quite uncomfortable. And it brings back memories. I had a colleague who asked me, okay, Gijs, but now we have these project plans and we have these project budgets. How often do those projects meet the deadlines? Do they run within budget? And do they also deliver in line with the set requirements? And then I had to admit that most of the time they didn't. So although the plans and the budgets gave the idea of being in control, I think in hindsight, the reality was that it was a false sense of control. And I learned that after we implemented the agile model, that there was also positive impact. So first of all, I learned that as a CFO, I was still in control. So that was good news. But next to that, I also learned that our cost base became more stable and as a result, better predictable. And that was driven by the fact that the capacity per value stream is fixed, and overruns are absolutely not allowed. And next to that, since the budgets were fixed, in case the business had ideas for new initiatives, new business initiatives, they could no longer come to me, they could no longer come to the CFO to ask for additional budget to execute this idea. It was up to the value streams to prioritize the new initiative with the existing book of work to see which one should deliver the highest value to clients and then focus on that initiative. So you have to do with the fixed capacity in the value streams. So that make the cost base more stable. And next to the stable cost base, I also learned that as a finance organization, we were able to improve our role as a strategic business partner. So instead of focusing the dialogue on the input side, on steering cost levels, we were focusing the dialogue more on the strategic side, on the value that's being delivered. And that's also why I mentioned earlier the set of financial, but also the non-financial KPIs, whether that is client satisfaction or improved conversion ratios or more stable IT. You can think of a lot of KPIs that are relevant when it comes to value delivery. But those KPIs and those discussions really helped to steer the business and to focus on the value that's being delivered. At the same time, I also have to admit that it can be challenging to find a direct link between the work that's being done and the value that's being delivered. But having the ongoing dialogue and driving that really improves the strategic role as a business partner for finance. So summarizing, how can finance or the CFO facilitate cooperation between IT and business? I would say, first of all, give up a certain granularity. And secondly, improve your role as a strategic business partner by driving value delivery.
That's a really fascinating perspective. But just one last question. Why is now the right time to shift into an agile context?
I think that implementing an agile organization should not be a goal in itself. However, being able to adjust to changing circumstances, to changing client preferences, is more important than ever, given the fact that the speed of change has never been so high. There's a lot of digitalization going on. There are fintechs that bring new innovations. There are multiple opportunities when it comes to data-driven solutions. And this speed of change is not going to decrease going forward. So yes, it is important that financial institutions are able to cooperate, to cope with this changing environment. And from that perspective, implementing an agile way of working can definitely be an enabler. And that's also why we see that so many institutions are currently adopting the approach. And to those organizations that didn't start yet or are only in the early stage of the journey, I would say the good news is that you can learn from those that already did it. So in the process, you have to make a lot of choices. And as a decision maker, you can learn from others. You don't have to invent the wheel yourself. And that's also what clients tell me. They really appreciate the support to have a sounding board, but also more hands-on with organizational and process design or cultural elements and the training of people. So my advice would be make sure that you leverage the learnings of others.
Well, thanks so much, Gijs, for your valuable insights and certainly a very fascinating perspective.
Thank you, James. It was a real pleasure to be here.
That's all for this installment of Sound of Finance, a podcast series by zeb Consulting. You can find further discussions on other interesting topics in the world of finance at our website, zeb.consulting.com. And be sure to subscribe wherever you get your podcasts. We hope you enjoyed today's conversation, and we'll talk to you in the next episode.